Thank you very much for joining me on this video. I want to talk to you today about the implications of co-signing a loan or a mortgage. I think it's important to understand because more and more it's an issue that we're going to run across with the complications today in buying a home. Over the last number of years, even with the settling of prices post-COVID, we've seen a remarkable increase in the prices of houses. Over the last, say, 7 years, they've doubled. And so it's more expensive to buy a property today than it was in the past, and that's a challenge. But in addition to that, we've seen interest rates go up remarkably. I mean, it wasn't that long ago, we could get a mortgage loan under 2%. Now we're looking at or above 6% often, and then add to that the stress test, and you've got a tough row to hoe to qualify for a mortgage. And then especially if we're talking with first-time buyers, often they've got bruised credit or no credit. They maybe haven't borrowed enough, they haven't established a solid credit score, or maybe they've been a little bit delinquent in some of their payments with their, say, Visa or credit cards or whatever, and so their credit is a little bit bruised. Or maybe they don't have enough income to qualify for the loan. And especially the case if they've added other debt. They bought some furniture, one thing or another, so their total debt service ratio is skewed a little bit, and they don't quite qualify for the loan. They're good people, they're a good bet. The bank would like to lend them the money, or the lending institution, but they say, you know, we can't unless they get a co-signer. And a co-signer is somebody who will guarantee the loan. And generally, it's going to fall on the shoulders of the parent. Now, they're going to go to their friends, they're going to go to people that they know who have deeper pockets than they do, and see if they can get somebody to co-sign. But the chances are it's going to be the parents that it's going to fall on. And that's not necessarily bad. The parents obviously have a vested interest in what's best for the kids, but the parents also probably own their own home, aren't in the process of buying another one, probably have sufficient equity in their home, likely have a good credit score, probably have a decent income. They got a lot of things the bank is going to like. And so that's going to solve the problem in getting them into that house. They're going to co-sign. But before they do, or before you encourage somebody to, and I don't want to get in trouble with my mortgage people, and I don't want to get in trouble with you as realtors who want to put a deal together, but I think it's important that they understand what's involved when they take up a pen and co-sign a loan. There's a principle called contingent liability. And what that means is, as far as the bank or lending institution is concerned, they have two parties now that are equally liable for the loan. The person whose name is on title and the person whose name is not on title. They don't care about that. As far as they're concerned, there's two different individuals they can draw on. And one of the things that will do, if you're the person that co-signed, it will limit your ability to get more credit. When you apply for a loan or a mortgage or a credit card, anything, they want to take a look at what your current obligations are. And as far as they're concerned, if you've co-signed for a mortgage, you're on the hook for that mortgage. And it's just as though you had the mortgage in your own name as far as the lender is concerned in terms of your obligations. So it may affect your ability to get a mortgage if you want to buy a new house. You need to think about that. And the other thing is, and this isn't the case with all lenders, but it can affect your credit score. If the people that you're signed for, usually your son or daughter, if they become a little bit cavalier in the way they pay back the debt, and they miss a payment and only a partial payment, and it's spotty in the way they're doing it, and it affects their credit score, the lender may affect your credit score. They don't always do it, but they can, so bear that in mind. Then the real challenge becomes, what happens if the loan becomes delinquent? They just flat out stop making payments. There's the challenge. The bank's going to go to them and lean on them and see if they can bring the loan into good standing. And then they're going to go to you as the co-signer, and they're going to lean on you and see if you can bring the loan into good standing. And you have to make a decision there. Even if you can, are you prepared to? If you don't, the chances are that the property may go into power of sale. Now, understand that the bank can add all kinds of charges, legal charges and delays and penalties and interest and all kinds of things to this process. But when the property is sold, any surplus will go back to the owner. So that equity is protected. But the owner is who gets the money, not you. So if you've been making some payments, you're going to lose those payments. It will go back to really on your shoulders if there's a shortfall. If they sell the property and there's not enough money to cover the loan, they're going to go after the person who holds the title of the property. They don't have any money. They're going to go after the cosigner who does have some money, and you're going to be responsible to pay the shortfall. So you say, well, what do I do? What can I do? If the loan goes into a default before they've started power of sale proceedings, you have to decide if you're going to bring the loan up into good standings. If you make payments, you can bring the loan up in good standings, but you have no protection for the money you're funneling in. You're protecting it for the kids. And that may be fine, but if it's a matrimonial home and they've split up, the spouse who didn't have maybe even name on title has an equity interest in the money in that property. So you need to be aware that that's happening. So what else can you do to protect your equity if you're going to be a cosigner? Well, there's a couple of things you might want to consider. I don't necessarily say you want to do them, but you might want to consider them. One is you may say, well, listen, I'm willing to co-sign the loan, but I want my name on title. I want to be a partial owner of that property. And if they're not prepared to give up a little bit of ownership, you can have a side agreement as to how much and how it's repaid and all the rest of it, then you're not prepared to sign on the line. Something you want to just keep in mind as a possibility. The other thing is this. Maybe after the property's conveyed, the mortgage is in place, maybe sometime after, you want to come to, say, your son, the person who is holding title of the property, and you may want to offer them a loan of, say, $20,000 for improvements in the property, for doing renovations and repairs and so on. And you're going to actually give them the $20,000, and you're going to register it as a second mortgage on title. Now, you're not doing it at the time of closing for a couple of reasons. One is it's not part of the down payment. They have to have proof of down, independent, unless it's a gift, independent of you. And the lawyer who's handling the transaction has to write off there's no subsequent encumbrances. Not sure why. The bank's protected either way, but at that point in time, you're not there with a second mortgage. Just after the fact, it's valid, it's for a reason, it's for home improvement, but now you're on title as a second mortgage holder. You say, well, what good does that do? I'm now owed another $20,000. Well, yeah, you are. And if it's used for improvement in the property, it's an investment. But the other thing is, if and when the first mortgage starts to become shaky because it's falling behind, rather than have the first mortgage issue the power of sale, you can issue the power of sale. And what that means there is that all the money you use now to make payments on that first mortgage will be protected because you're the one who's taking over title of the property through the power of sale process. And so there's some options that you can do. Understand we're not doing anything underhanded here at all. You may say, well, why do we have to do it after the fact? Well, it's the same as if the kids want to buy a car as well as buying a property. They would be advised, don't create that debt for the car until after you've bought and closed on the property. Do it after, not before. I'd encourage them not to do it at all because you don't want the debt load to increase, but you don't want it impacting their ability to borrow. And so until the mortgage is not only approved, but paid out, I wouldn't have them take the car loan out. I hope that all makes sense. It's something to think about. I just want to make sure that you're aware signing it isn't just a signature. It runs a lot deeper than that. Thank you very much for taking time to watch this video. I'll talk to you again next week.